and welcome to Friday's IPAW. If you've joined us every day this week, thank you, and congratulations, you're about to earn your 5th hour of non-structured CPD. Don't worry if you haven't been able to watch us live every day, as you can catch up. Make sure you've just subscribed to our email updates to receive all the information you've missed. Our theme today for advisors is what to do when it feels like your only option might be to walk away and do nothing. We're looking at how to work with clients that may offer various challenges and cases where you suspect you might not be able to offer a solution, and therefore subconsciously you may feel it's more trouble than it's worth to try. In today's session, we'll be considering what your options are, whether that's having a conversation with an insurer, obtaining more information from your client, or even thinking outside the traditional IP box.
Particularly when you consider that things don't always go to plan. As my grandmother used to say, accidents will happen. The Everyday Risk Report from MetLife really highlights just how likely that is. 68% of advisors they spoke to had clients who had been financially impacted by everyday accidents, and they cited over 453,000 hospital admissions from falls and trips alone over a 12-month period. This is corroborated by National Friendly's Bruised Britain report, which noted that 29% of adults surveyed had had at least one accident in the last 3 years, with the most common accident being a fall at home. The report suggested that 10% of hospital visits were because of accidents, and 76% of those led to someone being admitted, with an average hospital stay of over 4.5 days.
And if we look at the impact of these accidents, the Bruised Britain report showed that 57% of workers took unplanned leave, averaging 11.5 days. 24% of workers felt pressured to return to work early because of concerns about income and money, and sadly, 3% ultimately lost their job after their accident. These concerns about money meant that around 1/5 needed to dip into their savings, and 12% actually had to borrow money to survive. The report also showed that younger people were more at risk, but regardless of age, these figures are alarming and really help reinforce the need for advisors to try and find some kind of protection against income loss for every client.
Okay, so it's time to get our Friday content underway, and we're starting with a conversation about accident and ASU policies as an alternative income protection solution. ASU stands for Accident, Sickness and Unemployment. At the beginning of this year at the IPTF, we took the view that in keeping with our desire to help build a more financially resilient population, we should broaden our focus beyond traditional income protection, recognising that traditional IP policies are not suitable or available or affordable for everyone.
So this year, as we've been looking at accident and ASU in more detail, we've been working with a range of relevant firms to understand and help explain the proposition. And it's fair to say that since we've been talking about accident and ASU as an alternative solution, we've seen incredible interest from across the advisor community and wider industry, haven't we, Jo?
Absolutely. Our activities in this area have been some of the most popular this year, reinforcing our decision to focus more on it. We've developed an area on our website specifically for accident and ASU, but before you all head there to take a look, have a listen to the conversation that Vicky had with Ian Sawyer, Commercial Director at Howden Life and Health.
This year, the IPTF have widened our focus to include ASU insurance, recognising that traditional income protection isn't for everyone. We've seen a huge interest in ASU content, and we've decided to include it in IPAW this year. And I'm delighted to welcome Ian Sawyer, Commercial Director at Howden Life and Health, to have a chat about all things ASU. Hello, Ian.
Morning.
So let's start with the basics, Ian. What do we mean by ASU? What are the key things that you think we need to know?
Okay, so a very fundamental level, ASU, accident, sickness and unemployment cover, which can be purchased together as, accident, sickness and unemployment, or independently, accident, sickness on its own and unemployment on its own. I suppose it's key to understand that this is a general insurance product, which is annually or monthly renewable effectively. Covers comes under the different set of regulation. But in essence, it's a simple insurance product which meets the needs of a great many people, more people than perhaps it's given credit for. The key difference between ASU and other income protection, first and most obviously, then it's the benefit period. The benefit period is 12 months. There are limitations in terms of the amounts that you can cover. And there's limitations in terms of certain occupational groups as well, but that's more aimed at the unemployment side of things.
Thank you, Ian. A useful start to those new to ASU. So what does ASU typically cover in terms of earnings, claim duration, qualifying events, etc.?
Well, the biggest difference from traditional IP is the pre-existing conditions exclusion. So any ASU policy starts with a pre-ex conditions exclusion. Anything in the last 2 years will be excluded pretty much forever, to be quite frank, and a stress and back condition exclusion. Now, that's not a total exclusion. It's an exclusion from conditions which are met by GPs. If you're referred to a consultant at the more serious level, then a claim can be made. So that's that protects the insurer from abuse and from people purchasing it and just straight off claim straight away, and it enables them to manage costs, which keeps the cost of ASU to an affordable level. The issue is because there is no medical underwriting questions, everybody can get this cover. So unlike long-term IP, people can get some protection against future events, but not against pre-existing conditions. In many ways, it works a little bit like a private medical insurance.
As I've already mentioned, Ian, we've seen a huge amount of interest in ASU since we started talking about it in February, but we've also realised that advisors don't really know much about the product. What are the biggest misconceptions that you've found about ASU amongst advisors and clients, and how do you think they could be addressed?
Well, I think we need to look at history for that one, Vicky. ASU does have a bit of a checkered history in the sense that it is tarnished by the PPI mis-selling scandal, unfairly tarnished because, of course, that was delivered by banks, building societies, credit companies, and associate product. What we're talking about is an independent product sold by advisors for meeting the needs of individual customers. So many people think that ASU is a bad product. It is not. It meets the needs of a great many. Claims are paid out all the time and satisfy many great needs. It's low cost. It's not complicated by medical underwriting. So it does the job for consumers, or a job for consumers. Also, advisors seem to historically feel it's complex. And that's because historically there used to be mortgage products and income products, and mortgage products were limited to the amount of the mortgage plus around 25%. Now that doesn't meet the needs of many consumers. Your mortgage is usually about 33% of your overall expenditure, monthly expenditure, when you think of bills, food, entertainment, just living life. So that has a very limitation, but it is also considered, a mortgage risk is considered a lower risk, and therefore insurers give it a cheaper price. Products have moved on now. So you have products where it caters for the mortgage, your bills, and your additional income expenditure, so it's much more flexible. So advisors don't have to get wrapped up, or do I sell a mortgage product because it's cheaper? Because if I sell an income protection product, it's more expensive. Now they can, that's kind of melded together and satisfy both or all the client's needs.
Thanks, Ian. That's really clear. And I think on the subject of comparing products and understanding what they do and don't cover, I think because of some of the questions being asked by advisors, your firm, and particularly Andy Leonard from your firm, has helped us pull together a very simple ASU matrix, which we launched today. And you can access it www.iptf.co.uk in the advisor tools section and also in the ASU tools section. So worth having a look. I think that really will simplify it. And that's very much based on a write it yourself or refer it. So on that note, why do you think advisors should consider writing it for themselves?
Well, I think everybody feels more comfortable writing the business themselves and retaining the customer kind of relationship. Making recommendations to others is always considered a risk, and understandably so. But I think life moves on, doesn't it? The business has moved on. We've got to get more comfortable with signposting to experts who can cater for things. So the products that the IPTF have put together in a small panel represent a different set of quality choices. I think one of the things to your earlier question is, fear factor from advisors is that these brands that you'll see are not familiar brands. It's not an Aviva, it's not a Bupa, it's not a Legal and General. These are very small companies producing these products. But it's important to note that they are underwritten by very large bona fide insurance companies like AmTrust, who are a really important and big player, and Lloyd syndicates as well, sit behind the product, and they are as heavily regulated as any other product that you will use. So first off, if you're an advisor and you want to retain that customer contact, then yes, get familiar with the product. I would research the products and choose your favored one, which gives you the most amount of flexibility. But inevitably there will be situations where the product won't meet that particular client's needs, especially for higher value sums, because there are limits to how much each product will cover, usually around £2,500 a month, and then you have to get into a point of saying, right, okay, we need a combination of products to meet that client's needs. So that's when you might want to refer on to a specialist, and trust the fact that when you're picking a specialist, look into their credentials. Are they IPTF members? Are they PDG members? Do they have the history, the understanding, the technology, those types of things, and recognise that there are specialists in different markets. It's exactly the same as if you're referring to a mortgage broker or a IFA for investments and pensions.
Thanks, Ian. And we talked about consumers there a little bit. What kind of consumer is this product suitable for? Is it manual workers? Is it people who can't get traditional income protection because of health issues? Who's a typical customer? What do they look like?
Well, I think again, if you look back at history, this was really considered a blue collar worker. But we have clients who are oil executives, industry leaders, highly paid people in local government, all sorts of things. And I think that the difference is remember that the bigger risk for many people is unemployment. And there isn't an alternative to this. So we have a really, really broad range of customers who are satisfied by this product. There's no argument that long-term income protection is better from the AS, the accident sickness point of view. But of course, a great many people are either declined, completion rates in income protection are around 70%. I mean, 30% are either fading through the system, can't get GP records, being declined, being postponed. So this will provide an alternative, but it will give a 12-month benefit. Some people use it in tandem and have an AS for the first 12 months and then a 12-month deferment on long-term IP, especially if they also need unemployment cover. Unemployment cover on its own can also be purchased. So if you've got a client who is worried about their employment, long-term prospects, then they could have a long-term IP and an independent unemployment only plan. When we're talking about unemployment, please bear in mind that this is probably the most abused policy, maybe next to travel insurance, by consumers, where people tend to buy it when they know that their company is in trouble or their job is in trouble. And of course, any prior knowledge of restructures, redundancies within the client's business or employer will preclude them from making a claim.
Very good points, Ian. And yes, I think with all insurances that's the case, but specifically good to point out that there is abuse in this area, and we certainly want to make sure that that doesn't happen, and serve the underserved, but do it sensibly and grow the market sustainably. And I guess finally, Ian, if you had one wish for the ASU market over the next 12 months, what would that be?
Oh gosh, I would love more bona fide insurers to take an interest, perhaps team up, so offer an unemployment module to a long-term IP product. That would be really nice. Legal in general were used to be quite prevalent in this market, but exited and sold that part of the business. It would be great to see others join the fray, because there's demand out there.
Hopefully you found that a useful introduction or reminder of what accident and ASU is and who it might be suitable for. If you're interested in finding out more, what sort of things will people find on our website, Vicky?
Well, if anyone in our audience today wants to know more, if they go to our website, iptf.co.uk, click on the education area and then scroll down to Accident and ASU, they'll see a range of helpful and informative articles. They'll be able to access and view the webinar we ran in collaboration with MetLife and National Friendly, focusing on non-traditional forms of IP. So well worth a few minutes of your time to have a look. Also worth your time is our next panel discussion involving two of our insurer members, LV and Royal London, and Nicola Huxley, one of our IPTF ambassadors, where they discuss customers who may offer more of a challenge and the art of the possible in terms of helping them. Let's take a look.
Welcome everyone to this IPAW panel session. Our aim today is to acknowledge that not all cases are straightforward, and advisors will often encounter more complicated cases and may often think that getting terms and cover arranged for their client is impossible. In some cases, it may indeed be very difficult, but that's not always the case. And in the interest of avoiding foreseeable harm, it's important that advisors know the art of the possible. What can be done in circumstances that aren't necessarily straightforward? This is a really important conversation to start, and I would stress it is the start of a conversation and part of an ongoing conversation. I'd like to welcome my panellists today, Carl Hurd from LV, Craig Patterson from Royal London, and Nicola Huxley from Sphere Financial Services and one of our 7 ambassadors. Today's panel is about sharing insight, building understanding, and showing that when it comes to protecting non-traditional customers, there is often more possible than we think. Let's get started. So welcome everyone, thanks for joining us today. So let's begin with the big picture and set the scene here, and by acknowledging that although there are definitely conditions which remain problematic, underwriting has come a long way in recent times. So Craig, can I get your thoughts on this?
Yeah, I agree with that. I think that the customer journey has improved materially. The vast majority of income protection applications will be given an online decision. When a customer doesn't get an online decision and they're referred into an underwriting operation, again, the majority of those will get a decision at that point. And when evidence is required, we certainly default to asking the customer first. We'll only go to a third party like a GP if we really need to, if there's no other way around it, because we know that prolongs the application process and sometimes jeopardizes the sale. So I do think the journey's improved a lot. Eligibility is better. I think there's still there's still a way to go, but certainly customers who previously would have been declined or previously would have got non-standard terms are now more likely to be accepted or accepted on standard rates. And I think the mental health is a good example of that. There's still work to do, but we do see customers more likely accepted at standard rates now than they ever were before. And the other part I think I'd say is the product. So the product has come so far and so in such a short period of time. Now customers are more likely to get a known occupation definition. They will get options in terms of deferred periods and payment periods. And there's lots of ancillary benefits like fracture cover and hospitalisation benefits. So I do think the picture is materially better than it's been before.
Carl, would you agree? Are there reasons to be positive here?
Yeah, definitely. And I think, as Craig said there, it's the application journey has changed and continues to evolve as well. From ourselves, from an LV perspective, we have an advisor panel. So we sort of sense check ourselves with that advisor panel to say, what are you looking for as far as an underwriting journey is concerned? 50% or just over 50% told us they wanted to get indicative answers, get a decision as quickly as they could. So, for all of us insurers, we have our pre-underwriting teams, whether that's through email or telephone. From an LV perspective, we actually put the tool that our pre-underwriters use, we actually put that online and give it accessible to the advisors themselves so they can access that 24/7. The other bit actually, and Craig touched on it, is again, about 2/3 actually of our advisor panel, when they came back, said they were looking for simplicity. And that's, I think, something we all are striving to get to. So we're constantly, as all of us, as insurers, are looking at our question sets to say, how can we make them easier for the questions, make those questions easier for the client to answer, make it clearer, make it easier for them to understand. Because again, the more they understand, the more they're disclosing and telling us through that application journey, the quicker we can get then to a decision. And that decision might not be, yes, great, we can assure them as it is. But by getting them quickly to a decision, even if it's a loading or an exclusion or even a decline, it helps put that back in the hands of the advisor then to be able to say, right, what am I going to do next with this then? Whilst that client is still fairly warm, if you like, to that protection conversation and ready to find out if they need to have an alternative. So I think we are definitely enhancing that journey. And Craig made a very good point about GP reports. It is the nemesis of any underwriting journey still, even though we've had lots of changes in the industry over the years. And we do exactly the same thing. We'll go to the client first now and say, look, what more can you tell us about that disclosure before we have to go for a GP report?
Yeah, because very often they've got letters or information.
Yeah, exactly.
To share, so Nicola, when we were planning IPAW and discussing with advisors what sort of conditions make their hearts sink when clients mention it, mental health was always in the top 3 conditions. And we know that it's an often misunderstood area. So can you share an example of perhaps where you initially thought a client would be impossible to get cover for due to their mental health history or medication use, but somehow you managed to find a workable solution?
Yeah, so for me to use that as an example, I mean, mental health it's so complex, and it's something that as advisors we've got to deal with so sensitively from the very beginning. And I think it's why it causes us most headaches, because we're there empathising with the client and we're with them kind of on that journey of wanting them to have the cover. And the most recent one I can think of was I love a girl. She just had a baby. She was in her mid-20s, and unfortunately in her teenage years she had attempted suicide. And she'd had a baby, and then actually had just kind of proactively been concerned about her mental health, and taken a positive step to just go and check in with a GP. But what that meant was she had a historic mental health condition, which would have been way in the distance enough to kind of for everyone to kind of look at objectively, but then something more recently that in an automated system was just giving me a no. It was just giving me a no, and I was with this young girl, and I really felt for her. So I had to kind of take extra steps to talk to people and get her to talk to a doctor, and we had to talk about how it was represented on her medical report and everything else along that way. But I'm glad to say that she does now have cover through going that extra mile and being with her on that journey, which is something a few years ago I definitely wouldn't have been able to do.
It's a really good example of that, I think, because we're all, as Carl's described, we're trying to increase the proportion of customers who get an immediate decision. We know that's generally the right outcome, but it's impossible for a rules journey to accurately capture that kind of scenario. Where that happens, advisors need to have options, and that's why most insurers, we certainly do, we provide access to underwriters so you can phone up, talk that case through and make the right decision, not one that just comes out of an engine.
Yeah, absolutely. So of course, sometimes it's not the condition itself, but how it's framed in the application. So I wonder if I can ask all of you what advice you would give to advisors about how to position and preempt disclosures, especially around sensitive topics like anxiety and depression or newer drug treatments. So, and it's important here to highlight how important language is, I think. So Craig, if I come to you first.
Yeah, it's a hard one. I'm not going to tell Nicola how to do her job. You know, she will be an expert at having those conversations, putting customers at ease, and taking them through the process in a manner that's appropriate for them and their individual circumstances. From an underwriting and claims perspective, however, I can say that what's more important for IP than any other application is that the application form questions are answered as they're written, or asked as they're written, and including the help text, and that the customer's answers are recorded accurately. Now, that's important for any protection application, but for IP even more so, because conditions like a musculoskeletal problem, a minor mental health condition, or even the customer's occupation, they've got it's highly unlikely they will ever have an impact on an application for life or critical illness cover. But for income protection, they can be integral. So reminding customers of that and the importance of disclosing accurately is really, really important. And the only other thing I would say is that all of us insurers have a check your details process after the application form has been submitted. It's so important for advisors to encourage customers to engage with that. We find about 30% of customers will return that form with changes. So it's just giving everyone an extra bite at the cherry, an extra opportunity to make sure what they've told us is accurate, and crucially that we can pay out if there's a claim. Yeah,
absolutely. Carl, your thoughts?
Yeah, very much again echo that. It's anyone hoping that we were going to disagree on things today is going to be very disappointed. It is a sensitive subject. I think we've got to remember that the people sat in that room going through the application form are all human beings, as we all are, and mental health still has that bit of a stigma that people feel awkward talking about it. But again, and again, Nicola's mentioned it already with the clients she's had already there, it's how you frame that with the clients, and the importance of framing that they have to disclose, to be open over it. I think, and your example was a great one actually. I would say as advisors, sometimes it isn't the easiest conversation to have, and there's lots of things within an application form that can be sensitive. But actually it is an opportunity to deepen that relationship with your client and actually forge that relationship even further, especially as your example gave there, where you had enough information from that client to say, actually, I can still get you cover, and I can sort that out for you. Because that client, I'm sure now, is very wedded to you on the basis that you've deepened that conversation, you've deepened that relationship with them. So go back to what Craig said there. It is about positioning it with the client. There are going to be sensitive questions within this application. Mental health will be one of them. And I think it's also for the advisor to give time for that client to hear the question and also to reflect on their answer as well. Because appreciating it's a sensitive subject, for everybody, I think the worst thing an advisor could do is canter through it because they feel a bit awkward. But the more time they give a client to answer that, then again, you'll get them all an honest answer and hopefully get you to a solution as well, even if something has been disclosed.
I think one of the things I do is in our pre-appointment setup information, it has a trigger warning in your reminder email. So it says, trigger warning, we will be talking about this, we're going to need more details. If you think that we need to take more time or have a longer appointment, or you need to be separate from somebody to have these conversations properly, please do let us know. So we give them the opportunity to do that, so we prepare them for that. And then you were saying about, I think the other thing advisors can do is sometimes, and I've been victim of this myself, is we have a tendency to not want to fill free form boxes in because we want an accept at the end. And actually we know if there's a free form box that it's not going to accept at the end. But actually those free form boxes and the explanation of somebody's ADHD and why they've recently seen a psychologist, or something that stops somebody asking another question that might be sensitive that actually they've answered whilst with you, because you're their safe space, it's important to put all that detail in. So fight that urge to automate everything, and sometimes voluntarily give that extra bit of detail that you've been told, because you're not going to be telling anything that's going to cause you any problem. You're going to be having an open conversation and treat the insurers in that they would want to have the cover in the right way as well. So like, be open and share.
Yeah, and I think it's useful to flag here the guide that the PDG produced last year, which remains relevant and discusses mental health and income protection. We'll make sure that we share the document today, but just as our discussion has highlighted, the document highlights the need to be careful with the language that we use, and when we're talking about mental health conditions, stress and anxiety are not interchangeable. For example, they're different things. They all need to be disclosed, and to manage client expectations as well, so that they give you an accurate and informed position that you can take forward with the insurer. So as we were planning this session about the sorts of clients that advisors might find problematic, I've mentioned mental health was top of the list, but not far behind it was another issue which is currently less prolific, but it's definitely one where there is as much uncertainty, and that is weight loss medication. So Nicola, I know you and I have spoken about this before. What's your experience with this? Are you seeing more clients who want to discuss this, and how confident do you feel in this area?
It's definitely something we're getting a lot of disclosure for, and it's funny because actually a lot of the disclosures we've had on it have almost been accidental. Like, sometimes the clients haven't even recognised that they need to flag it up, because they don't see it in the same way as they do a medical issue. So it's one for advisors to be really keen on, as in, if you're not getting lots of disclosures from it, something in your question set isn't right, because I've certainly had plenty of them to know that it's out there. And it's one of those things you're kind of learning on the go. And I would imagine as insurers, you're learning on the hoof as well, because it's brand new. It's kind of come like a steam train, and you've got to kind of work out what's different and how it's going to be dealt with. Again, I think it's applying some sensitivity. The way I'd liken it to is people who vape, who then, when you have to tell them to go with smokers, don't like it. And when you've got a lot of recent weight loss from the weight loss drugs, you've got to prompt them that actually maybe some of that won't get taken into account until it's further down the line. So as advisors, we've got to think about it both now and in the future. And I think maybe some more communication coming out of the insurers in our direction to help us with that ongoing, the same way as if somebody's progressing towards their non-smoking status, we know like kind of how to underwrite that mentally ourselves. I think we need some more guidance on how to underwrite this mentally ourselves. Yeah. Albeit when we're all learning at the same time.
To manage expectations. Yeah. So, Carl, can I ask you, and I'll come to you, Craig, as well, just to ask how insurers are thinking about this in underwriting terms, and how advisors like Nicola can approach this with confidence. So what is it they need to know?
You're right on it being a big change, and it's. I was reading a news article the other day. I think it's something like they're estimating 3.4 million people will be eligible for it through the NHS over the next 10 or 12 years. So that's the NHS one. So that's before we even start talking about all the private ones that are going on right now. And I guess you can't go online anywhere now without seeing adverts for all of these different companies that say you can take out a weight loss drug. But you're right, it is a changing landscape as well. I think there's a new one in the USA now they're trialling, which is now a higher dosage, so it has different effects again. So for us as insurers, I'm sure Craig will agree, we are trying to get as knowledgeable as we can on this as well. It hasn't been around for that long either, so they're already quoting side effects, but again, nobody really knows how prevalent they are. But you're right, it is, if the client's disclosing it, then I think from our position, you mentioned about the weight loss and how that can affect, very obviously what it does, it affects BMI. And if somebody's taking those steps, that's brilliant. Somebody is losing weight and it's the right thing to do. But I guess from an insurance perspective, we would just want to understand why. So where have they come from on that journey? With any weight loss program, these drugs included, the small print always says, as part of a calorie-controlled diet and exercise as well. And already, I think, with the weight loss drugs, people are seeing this bounce back where the weight is coming back on. So when it is affecting BMI, this is the bit where we will be asking more questions. How long have they been taking the medication for? What's their journey been like on it so far? To try and understand, is this a steady weight loss? Is their BMI coming down gradually and in the right way? And in a way that's going to be sustainable as well. Because if a client takes that policy and then very quickly bounces back to a high BMI, then that just causes difficulties.
And Craig, your thoughts?
Yeah, I agree with that. I think Carl's right. The jury's still out on some of the long-term effects of these medications, but short-term, it's overwhelmingly positive. And particularly for cardiovascular health, it could be transformational in this country and beyond. From an underwriting perspective, we ask a question about prescribed medication, so we would expect customers to disclose it in response to that. When they do, as Nicola says, we will be cautious of customers that have lost large amounts of weight in recent periods of time. And if that happens, then we might add some of the weight back on. But if the weight loss has been sustained for 12 months, I think we have in our philosophy, then we will treat that customer based on their current height weight. So that's a really fantastic outcome. And Nicola also mentioned about what happens after the plan starts. That's really important, because even if, for example, the customer is accepted with a rating when the plan starts, most companies like Royal London will offer a lifestyle review whereby they can come back once that 12 months has elapsed, and we'll review them again and potentially remove that loading.
Yeah, perfect. Okay, so I'm aware of time, but there is another issue that I think can be off-putting or daunting for advisors, which is fluctuating incomes. So can we perhaps discuss the financial underwriting and touching on the theme of this session? So Craig, I'll come to you first.
Hugely important. We've tried to make the application process slick and efficient by really reducing the amount of financial underwriting we do. So we don't ask for financial questionnaires, we don't ask for third-party verification of income the way we'll sometimes do on a large life or CI policy. But we do ask the customers to confirm their taxable income, and that's really important, because that is what the sum assured that the customer is given is based on. So it's really important that they get that right. And we do see examples of that not being the case. Sometimes, for example, a self-employed customer will disclose their turnover rather than their income, and it can result in poor outcomes at claim. It's really important that that's disclosed accurately. And it's not just a one and done, because after the plan starts, the customer's income may change, and that again might have a bearing on the amount that we can pay. So it needs to be accurate up front, but it needs to be reviewed regularly to make sure that the cover that the customer's got remains appropriate for them, right the way through the policy.
Yes, absolutely. Carl, any thoughts to add there?
Yeah, no, I think the key words there are taxable income. It's not what somebody thinks they earn, but it is the taxable income, because that's what we're looking at when we are underwriting at claim stage and everything else as well. And I think there's another angle here a little bit as well, is if you are talking to somebody who's self-employed and they are using an accountant, then prompt them leading up to that application and everything else to speak to their accountant and clarify what is that taxable income, so they're not coming in with a figure that's in their head perhaps. And actually, for some advisors, that might be a nice new professional connection for you with that particular accountant. So again, don't be afraid of that. Embrace it, because it could actually enhance that advisor's business anyway by bringing that accountant in as part of the introducer family, perhaps.
Absolutely. And Nicola, perhaps I can get your view as an advisor. So when you're dealing with a client with an unstable income because they're self-employed or a gig worker, what approach do you take?
I mean, I'm quite lucky because we're predominantly mortgage based, so we do have figures in front of us. So the taxable income for the mortgage is always the same as the taxable income for you guys. So that's brilliant and that's easy to navigate. What's not easy to navigate is constant reviews for changes. So it doesn't matter how much you try to constantly engage with your client every year, they're often not keen to have that extra life admin all the time. Having tried lots of different ways of doing it, I know that's to be the case. And I think the other kind of grey area in that is, even if we've got it spot on at point of application, that can change for somebody that's self-employed. And I'm going to use the example of my dad here. So he was self-employed and then was quite sick for quite a long time before he maybe decided he couldn't work, because a lot of self-employed people will go into work much longer than an employed person, maybe, because it's their business and it's a lot more complicated than just taking an income protection policy, to get to the point that by the time they're claiming, their income may already be under what it is naturally. And I think that's a bit that worries us as advisors, and then ultimately worries our clients and puts a disturbance into having the product, which shouldn't be there. So like when we have insurers who will enable us to lock in that financial underwriting at the beginning, particularly for your self-employed people and your people who have fluctuating income or contractors or whatever it might be, freelancers, it's really, really useful to have that said, like, actually, you know, at that point you did, and you've qualified for that at that point. We're going to make sure you can claim on that when you need it, because that's when you bought it and that was all in good faith, and that's how it works. And I understand for you guys it's more complicated, but that we want as few objections into the claims process as possible, and to know that's boxed off is a real reassurance for some clients. For some clients we can just ignore that completely because their jobs are their jobs, and you know their income is their income, and you're not going anywhere near their earned salary and their underwriting sums anyway. But for some clients that's key, and I think it's something that needs to move forward a little bit more in terms of underwriting.
It's a really interesting example, that claim one about your dad. I know that in our claims team, we would not penalise customers who tried to keep working despite a change in their health. It's a really commendable thing to do. But it's quite hard to give a customer confidence that that's going to be the outcome when it's not laid out in black and white in the terms and conditions. I think we've got more to do in giving customers confidence that we'll take the right approach at claim stage.
Yeah, absolutely.
I think it's fair to say, actually, with a claim assessor, especially for financial underwriting on claim, you know, they are looking to try and get that claim paid. So there's lots of different ways where we will speak to that client and say, look, give us a longer period to look at. How can we average incomes out to try and get them to that figure? And I would say it is one of the biggest things we get. There's lots of different things the claims assessors deal with, but it is one of those things where they're trying to work with the client to say.
The difficulty in that is, like you said, it's the creating a grey area when, you know, as advisors, we know you all want to pay the claim, but it's also creating a barrier at point of claim. If you're sick and then someone's asking you more and more and more questions and asking you to prove more and more stuff, there'll be a point where you go, they're just going to say, no, I can't be bothered with this. And actually what we need to do is make this kind of fit that journey and make it there when we need to. And I think it's just something that needs to, like I said, it's a niche part of it, isn't it? But like I said, there probably just is a bit more to do to have the faith in the product that we all think is now most important for the clients. The income protection is protecting people's income is first. Certainly in my business, it comes before critical illness cover, which makes underwriting harder. It makes claims a bit trickier. So we've got to take those barriers in underwriting and claim away in some way, shape or form so that it can be fit for purpose and that barrier is removed for the advisors as well as the clients, I think.
No, I appreciate that. I mean, our economy has changed so much, hasn't it? You know, with people holding down multiple jobs, or, you know, an employed role and a self-employed role because they've started a business up during the pandemic, perhaps.
Yeah.
So we all, again, and I'm sure Craig will agree, we're all, as insurers, trying to work out how more we can flex to take that into account. There's different tools available. For all of us, we have different tools that advisors can use to help them work out what somebody can insure. Because it's not as simple now as for a lot of clients are saying, you earn that much, you want to insure X percentage of it, and that's what we're going to do.
Yeah.
You know, so I get it so much harder now for the advisors for these different incomes that come in. But I would say, you know, at the beginning, we're definitely there to help, you know, with the sales teams, etc. Both of us here, you know, as companies, we have a lot of experience in this world. So our teams are there to help with that. And also at the claim stage as well. As I said, the claims assessors are there to try and help as much as possible. But sometimes it is unravelling a bit of a story sometimes.
Mm. So then as a final point, Carl, I'm going to start with you. What would you say is the one thing that you wish more advisors understood when working with clients who fall outside the sort of textbook profile, and the one message you'd want people to take away from today?
Just one. Okay.
Just the one, yeah.
I think actually Nicola's given a really good example of here is you know, don't be afraid of the complicated ones. Don't shy away from them. Embrace them actually, because it is a really good opportunity to get closer to a client and go through that question set. And when you do get that cover, even if it is a limited amount of cover for whatever they might have disclosed, that client is going to be so much closer to you as well throughout your relationship with them, and become a future client and ongoing. So yeah, don't shy away. You know, we are doing our best to insure these clients. So yeah, do come to us, do approach them, be sensitive with that information, and then hopefully we can get them insured and forge that relationship.
Craig, what's the one message you hope people will take away?
I do think the picture with IP is really positive. It's a real success story for the industry. The market has grown massively, so I don't want to be negative. I just think the fact that the market has grown so much, different advisors are selling it, different customers are buying it, and with that goes added responsibility to make sure that we pay out. That is what we're here to do, and with that in mind, I think disclosure is the most important message. Accurately answering the questions to make sure that we can pay out in the event of claim is the most important thing for IP.
Yeah. And Nicola, as an advisor, I wonder what you think advisors watching will find the most interesting takeaway today.
I think, well, I'm probably going to go off piece a little bit here. It's unlike me. But I think there will be some advisors who will never ever be comfortable getting to the nitty-gritty of some of the stuff we've talked about today. And I think those advisors maybe have got to be honest with themselves. And if they can't write that, then they maybe need to refer that to people who are more interested and have got that extra desire or extra knowledge base or extra time or whatever it might be that create passion even to do the right thing within that. I've worked with people in the past who were uncomfortable even with just the height and weight questions. They never really got much beyond that. But again, you end up with a bit of a knowledge of lots of different medical conditions. You do get to know your clients on a different level, as you've said, but it strengthens that bond as a client. But equally, if you're not comfortable with that, then recognise that discomfort and don't shy away from it, and don't leave those clients uncovered because you can't get to that next level of question and your own barriers are causing that problem. Find somebody who will help you with that and go from there. That's what I would say.
Yeah, because I think as we are trying to say, there is often a way to cover.
Yeah.
Even if you suspect there's not.
Yeah.
Well, listen, thank you all, not just for your insight today, but for your willingness to have a conversation that opens doors for clients that are too often overlooked. What we've heard today is clear that non-traditional doesn't mean uninsurable. And with the right knowledge, partnerships and persistence, we can serve more people with advice that makes a real impact. So let's keep pushing for possibility and never assume a no before we've explored a maybe. Thank you all.
Thank you.
Thank you.
Some great insight there into the art of the possible and options available and what they might be. I think the message is clear. It's always worth asking questions to see what might be available, and the situation is continually evolving. As Craig Patterson mentioned, the bottom line is that insurers are looking for ways to pay claims, so it's about us working together to achieve the best outcome for everyone.
Absolutely. As the saying goes, knowledge is power. And speaking of knowledge, we wanted to spend some time now highlighting how IPTF can help you improve yours and show you what is available via our website. Here's a short clip which we hope you find useful.
At the IPTF, we're passionate about education and making income protection easy to understand for everyone, whether you're experienced in the industry or just learning about it for the first time. Through engaging podcasts, interactive workshops, informative videos, technical articles, and real-life case studies, we're on a mission to break down barriers and make income protection accessible to all. Because when people understand its value, they're empowered to make better financial decisions. To find out more about our commitment to education, go to iptf.co.uk and click on Education in the menu bar. The best progress happens when we work together in collaboration. At the IPTF, we champion collaboration across the industry, bringing insurers, advisors, distributors, support services and key stakeholders together through initiatives like Income Protection Action Week, themed focus areas and strategic partnerships. We're proud to work alongside our affiliate partners, creating a stronger, more supportive environment for both industry professionals and consumers alike. Because when we join forces, we can achieve so much more. To find out more about our passion for collaboration, go to iptf.co.uk and click on Collaboration in the menu bar. Knowledge is power, and at the IPTF, we're committed to uncovering the insights that shape the future of income protection. Our continuous research delves into market trends, consumer needs, and identifies new opportunities, helping us drive meaningful change and market growth. By understanding the data, we can better address underserved markets and ensure income protection becomes a core part of every financial plan. To find out more about our dedication to knowledge and insights, go to iptf.co.uk and click on Insights in the menu bar.
We hope that gives you a flavour of what's available. It's worth exploring our website to see the resources available. If you think something is missing, please do get in touch. Just like you, we're committed to continuous improvement and always happy to take feedback and listen to ideas.
It's now time for our final advisor montage of the week, and as you might expect, we've been asking about more challenging cases.
Irregular incomes can be a problem. With income protection, you have to work a minimum of 16 hours a week. So quite often you need to look to other providers. MetLife is a particularly good one that I use. I think a bit of trivia that they were the first company to pay out on the Titanic, apparently. So it was, always sticks in my mind.
We still need to cover those vulnerable clients who perhaps have medical conditions or have irregular incomes. One way that we support clients with medical conditions is really understanding what that medical condition is and how it impacts them on a day-to-day basis, especially in line with their occupation. Sometimes if income protection isn't available, it's pivoting to other policies, such as an ASU policy, possibly a critical illness policy, or a policy which doesn't necessarily have any financial or medical underwriting attached to it, which will still give some financial benefit in the event of ill health. We also look at policies where financial underwriting isn't always required, perhaps policies that are designed to protect a mortgage payment, which is unrelated to their income, but will still ensure that that biggest financial commitment is paid in the event of ill health.
I think most of the clients I see these days have some kind of medical conditions, so it's just a case of utilising all the underwriting tools, speaking to underwriters, knowing which providers are better to talk to, and then just trying to place it as best you can. Irregular incomes, always speak to the BDM. Every provider has sort of slightly different ways of looking at things, so it's always a good idea to speak to the BDM and just run that client past them if they've got anything irregular.
I'd say my default approach with a client with pre-existing medical conditions is assume that I can still get them cover. So I'd always do a set of medical questions with them to actually work out exactly what I'm working with, because I think people's perception is very often that they can't get cover, when the reality is that they might just be able to. And then it's taking that information away to work out where can I actually place this, because I'm often surprised that I can place some of these bits and bobs. But then if I am completely butting my head up against a brick wall when it comes to placing that sort of case, I know I've always got ASU sitting in the background where, you know what, I can do it. And there is no medical questionnaire on there. So as long as I can, the customer can afford it, they can have it.
You've got people who have got high BMI, you've got people who are over the age of 60, and you've got people who have got various medical disclosures where they can't get it, and there's no option for group income protection because maybe they might be an individual. So what do I do here is try and utilise critical illness, but the additional benefits like fracture cover, depending on their occupation, the need, if they're playing hobbies and sports, etc., that could be a pretty useful avenue if they had an accident, because an accident could be a break. What else do I do? You've got the things like MetLife everyday active lifestyle cover. It's not a replacement for income protection at all, but when you go through all of the options, it could be a backup plan, let's say.
So whilst ASU policies are available for a non-traditional client where perhaps traditional income protection isn't going to fit, we also look at policies where no financial underwriting is required or medical underwriting is required, and there are some fantastic options out there which just offers some level of security for a client in the event of ill health, especially for accident related conditions. So if you've got clients that are perhaps in higher risk occupations or have hobbies or things that are going to increase the likelihood of them being off work as a result of an accident based policy is a great alternative where a traditional medically and financially underwritten income protection policy isn't going to work for them.
So I had some clients, it was quite historic, but some clients who had a mix of two conditions that you still can't get income protection for these days, and they have an accident, sickness and unemployment policy that doesn't cover these conditions, but it covers everything else. So it covers their mortgage plus 110%, but it just literally means that they've got some money coming in if they're sick with anything that isn't related to these conditions that meant the combination of the two, they couldn't have income protection.
It's always useful to hear from industry peers and like-minded people, and we hope that throughout the week you have found inspiration in what we and our guests have shared. For advisors, as we close today, this week of IPAW, we encourage you to consider recent cases that you may have considered too challenging to pursue and invite yourself to revisit those and explore what else might be possible. Be curious. Establish any other available options by asking insurers, BDMs, using tools and underwriting resources, and even exploring accident and ASU if this could be an option. Before we bring this week to a close, it's time for us to reflect on the week and pick out some of our personal highlights. Jo, what was your favourite moment?
As in previous years, it's very hard to pick just one, isn't it? Filming customer fortunes was possibly our most challenging IPAW assignment to date, but great fun. On a more serious note, I think for me it would be between our mindset session on day one, led by Matthew Chapman, as that really represents the foundation upon which we look to build. It's so important that advisors understand the important role that they play and the difference they can make. That said, today's panel on the art of the possible for customers who may be challenging was also so important. Let's face it, the perfect IP client is few and far between, and it's therefore important that advisors feel equipped to seek out the answers and assistance they may need for their clients. How about you?
Well, like you, it's hard to pick just one. As there have been so many, and I've really enjoyed the week. I always like to see content that is directly applicable and forward-thinking for today's ever-changing world. And so for me, I'd highlight the tutorials on Wednesday from Chris Targett and Rosalia, which I know will be really useful and a great resource.
Great picks there. What have your favourite moments been? As usual, we're keen to know what you think, what worked well for you for this week, and what you'd like to see in terms of future content from the IPTF. We have big plans for 2026 and are committed to collaborating across the industry to provide insightful and educational content. But believe me when I say that you definitely have the power to help shape that. So please do provide your feedback when we send you a note to ask for it, and share your thoughts and insights online. Tag us and use hashtag IPAW 2025. Together we can keep the momentum going that we are seeing in the market, be it pandemics, challenging geopolitical situations and even market reviews. It takes an industry, so let's keep it going.
We'll be back again next year. Jo, do we have a date yet?
We do actually, Vicky. The week of the 21st of September will be IPAW 2026.
Wow. Let's put that in the diary. But don't be an IPTF stranger. Please collaborate with us to ensure more households and businesses are financially resilient to whatever may come our way in the coming months and years. Thank you for watching.
Thanks for watching.
Bye.
Lovely. I think that's everything. I think that's a wrap.
Yeah.
Well done.
Thank you. Well done, guys.
That's in-person filming for IPAW 2025.
It's a wrap.